Good afternoon and a very warm welcome to all of you. I'm Neil Brown and I'm the head of Anc Asset Management. Thank you for joining us for the second Where Will the Money Be Made webinar of the year. In the past, we were only able to do this twice a year, but with the world moving into the digital space, it's becoming much easier to do this more regularly. Thank you so much for spending your time with us. We really do appreciate it. It has been more than a year since the COVID-19 pandemic sent us all into protective bubbles, and it's been a tumultuous year and a bit, with economic activity being massively disruptive, markets taking a pummeling and then recovering and reaching new highs in some cases. Unprecedented stimulus and liquidity being provided with low and negative interest rates in many countries. More recently, the threat of rising inflation and the second and third waves of the pandemic, counterbalanced by the rollout of vaccines at varying paces in different countries, giving rise to the loosening of restrictions and the opening of economies, has all led to an eventful and challenging year in which to invest. Being a boutique manager, Anc is fortunate to be in a position where we are able to be nimble and quickly make effective changes as the unfolding events require us to do. This nimbility has enabled us to successfully navigate this tough time for all our clients. Our speakers today will unpack the key economic factors that we believe are influencing markets. They will explain how we've taken these into account in our investment process, and as a result, how we are positioned to make our clients money over the next year. Firstly, Nolan will cover all of that and the fixed income asset class, followed by Peter, who will deal with global and local equities. We'll then end with Nick Dennis, the fund manager of the Anc Global Equity Fund, which won the 2020 Raging Bull Award for the best FSCA-approved offshore global equity fund for the best straight performance over 3 years. Over the 3 years ending at the end of last year, the fund returned just over 29% per annum in dollars. And for the calendar year, it recorded a whopping 91% in US dollars, an amazing achievement. The fund did take a bit of performance pain in the first quarter of this year, and Nick will share his thoughts and views on markets and the fund's performance and positioning. We'll have a Q&A session at the end, but please feel free to post any questions that come to mind during the session in the Q&A section. We'll pick them up from there and endeavor to answer as many of them as possible at the end. Without further ado, I'd now like to hand over to Nolan Wapenaar, co-CIO and head of fixed income at Anc Asset Management.
Thank you very much, Neil. That is quite an introduction. Hello, everybody. It is absolutely wonderful to be presenting to you again. As Neil said, I'm responsible for fixed income at Anc. Fixed income has been through a thrilling first quarter of 2021. So I'm going to unpack that a little bit, whereafter I'm going to talk about where that leaves us and what our outlook is for the future. And finally, sort of pull that together in terms of our asset allocation views. The whole intention is that I'm going to talk for about 20 minutes. I'm going to need to trot at a reasonable pace to complete everything. And then I'm going to hand over to Peter, who's going to speak about the equity side of investments. So the starting point for 2021 has been, what I've done here is collected a bunch of headlines that I found from various news outlets, and they talk about the bond market meltdown, they talk about the treasury rout, etc. And that really sums up a very difficult period for fixed income in Q1. But really what they are talking about, if we unpack it a bit more, is the fact that yields have been rising. So what we have got here is a chart that shows the yield on the US 10-year bonds over time. And you can see how it was gently drifting downwards. The COVID crisis hit, bonds drifted, sort of shot a lot lower. But since about September last year, bond yields have started increasing, and then from February this year, this shot up very, very rapidly. And this rising bond yield, as bond yields go up, bond prices go down. So we've seen a lot of negative bond prices and a lot of drag in the fixed income space, and hence the headlines, the sensationalist headlines that we've seen. But let's unpack why that's taken place. And I'm going to talk about three specific factors. I'm going to talk primarily around inflation, because that's a narrative that has been very, very central to the first quarter. Then I'll just touch on two other factors that one needs to be aware of. So the idea behind this factor is that, as we sit here, a year ago, we were at the height of the COVID crisis. We were at the height of the lockdown, and economies were slowing down, dropping off a cliff, and you saw massive reductions in economic growth, negative economic growth. A year on, if we look over the last 12 months, you've seen economic growth numbers that are going to be published, which are probably going to be the highest economic growth numbers of my lifetime. We're going to see 8% economic growth in the USA. That's unthought of. We're going to see, potentially double-digit growth in certain other regions. Again, unthought of. And it's really the recovery from the economic malaise of last year. But along with the highest economic growth in my lifetime comes some of the highest inflation recovery as well. So we've got a catch-up inflation that's going to take place, and the markets are concerned about this. The big issue is, will this inflation start to feed on itself and become a self-perpetuating sort of virtuous circle, or is it going to spike and then slow down? Very much we are of the view that it's going to spike as we have this catch-up inflation, and then it's going to come off and we're going to go back to historic sort of inflation levels. And that's in line with actually the thinking of most of the global central banks. I'm just going to touch on a few reasons that we see this. And the first is a chart that I've got in front of you, which unpacks US inflation, global inflation. And essentially, if we start at the bottom, what you've got is, it's reading across from the bottom, you've got services inflation, durable goods, non-durable goods, food and energy. But what's more important is the way you could look at this chart is the most stable items, such as rent, are in the bottom category, and the most volatile items, such as oil prices and energy, are in the top category. And the point is that over time, since the 1970s through to now, what you have generally seen is that the portion of the US CPI bucket that is stable, you're not going to see 20, 30% increases in your rental, followed by a 15% reduction. The portion that is stable has been growing within the US inflation basket, and that means that naturally US inflation has become more and more stable. We expect that this in itself is going to continue to be the case, and therefore it's very reasonable to expect that once the catch-up inflation is out the way, that inflation is going to normalize around historic levels. Another useful chart just to be aware of is one that shows savings. So if I look at the little line graphs at the bottom, what you have got is US savings in billions of dollars, and we get to about $1 trillion of savings, just over $1 trillion of savings just before the crisis hit. At the time of the crisis, massive uncertainty, job insecurity, you didn't know how it was going to play out. So a lot of people very quickly put as much money as they could aside, and you saw savings amount numbers shoot through the roof. Stimulus checks from the US government actually helped a lot as well. Thereafter, though, this rainy day fund that was put aside has actually been absorbed back into the economy. So we've seen people spending down their savings, and a lot of that has actually taken place already, and savings aren't materially away from where they, from where they were previously. So in the context of, the personal balance sheets are a lot stronger. There's a concern within the markets that there's going to be a massive, people coming to the market with massive spending, massive sort of revenge spend. A lot of that's taken place. And again, we don't think that that creates an environment where this inflation is going to feed on itself. So we think that the inflation spikes and then comes back to normal. Other factors to be aware of in the bond market is firstly short selling. And what that means is people have borrowed bonds that they don't own and they've sold them into the market. And as they're selling these bonds, bond prices go down. That's this sort of massive short selling that's taking place. The short selling in the first quarter of this year has been the most extreme almost in history, with over $100 billion of bonds being short sold per month. In fact, in many cases more. And it got to the extent at one stage late in March where you actually couldn't borrow any more bonds because there just wasn't supply. So there's been this massive sale of bonds by hedge funds, which has driven market prices down. Interestingly, at some point, hedge funds are going to need to buy those bonds back. And while this was a very negative factor in the first quarter, it's going to turn to a positive factor in future. Final factor just to be aware of is what impacted the bond market is government borrowing. So it's a very busy chart. And really what I want to talk about is just the big blue bars. And the big blue bars represent the amount of borrowings from OECD governments around the world. And it's been a very stable borrowing of about $10 trillion by all the OECD governments added together. What happened, though, in 2020 is that governments needed to fund fiscal support. They needed to fund, health measures, etc. And you saw government borrowing shoot through the roof. It's almost 60% higher than it was, and that continues. This year, we've been speaking about Biden's $1.9 trillion stimulus package. That's got to be funded. Governments are borrowing the money. To borrow the money, they're selling bonds. So not only are the short sellers selling bonds, but there's been a massive government selling of bonds as well. That incrementally, that additional new sort of borrowing requirements is now slowing down dramatically. And again, this is a factor that was quite negative for the bond market, which is turning positive. So the bond market as such has had sort of three core aspects of it that have all converged to be a very, very negative first quarter and the bond market meltdown. What does that mean in South Africa, though, pulling it to South Africa? Well, we've got the same chart as we had for US bonds, where you've got the yield on the South African government bond over 10 years. You can see the COVID spike, and you can see of late how our bond yields have been sucked higher. In other words, our bond prices have been sucked lower through this process. It is very important to note, though, that our bonds have been sucked lower to a far, far smaller extent than the developed market, than the US bonds. So we have felt some sympathy pains, if you want, but it has not been to the same extent as the US bonds. And actually, we've been quite defensive in global sort of considerations. But it's going to be okay. We've been through a bond market meltdown. We've been through, a bond market rout, as they call it. I prepared this presentation on the 22nd of April, and when I was putting it together, I quickly took the year-to-date numbers of a bunch of Ang's bond funds over the short period, over the period of the bond market meltdown. And the point is that on a year-to-date basis, all of the funds that I mentioned actually were positive. So yes, it has been a challenging environment. It's been like driving with your handbrake up. But at the end of the day, bonds have actually still generated positive returns. And that's the nature of bonds is, in a difficult environment, your capital is reasonably assured. So they are a defensive asset class. And it's that nature of defensiveness that's come through. But where does that leave us today in terms of South African asset classes? And let's start by looking at the Rand. And our view is that the Rand is fair. Anc applies a purchasing power parity model, a PPP model, to looking at the Rand. And broadly speaking, what that says is that over longer periods of time, the Rand should depreciate against the dollar by approximately the inflation differential between the two countries, between South Africa and the USA. When we graph that, we like to look at a range for the Rand rather than a spot point. So you've got that thick blue band that sort of gradually drifts upwards on the chart. And that represents Anc's view of where the fair value of the Rand is on our PPP model. The jagged blue line then becomes where the Rand actually traded. And you can see how at the COVID crisis, the Rand set new record weakness levels. And since then, it's come storming back and it actually finds itself pretty close to the midpoint of our fair range. So from that perspective, we think that the Rand is fair. We think that this is a decent time if you want to externalize money from South Africa and invest abroad. But we don't think that you necessarily want to look towards the Rand weakness or a big blowout in the Rand for future returns. And rather, if you're externalizing money, you should be doing it for reasons of either accessing investments that aren't available in South Africa or for peace of mind, having a portion of your nest egg abroad. So the Rand is fair, but South African bonds are cheap. And what we mean by that is that if you look at that blue line on top, that's the bond yield that I was graphing earlier on the South African 10-year bond. And you can see how the bond yield of late in April, towards April, starts pushing upwards as bonds have been weakening. In contrast, what we've got is a composite which represents actually the theoretical or fundamental value of the bonds, which comprises US interest rates plus an inflation differential between the two countries, plus the credit premium that South Africa would pay. If you look at that, where you come out is that the fundamental fair value of our bonds has been getting higher and higher. The yield has been getting lower, but at the same time, our bonds have been pushing weaker. So our bonds have moved in a different direction to where their fundamentals have. And right now, our bonds are some of the cheapest levels they've ever been. So we find bonds quite attractive. Another way of looking at bonds is in terms of real yields, which says take the yield on the government bond, say the 10-year yield at 9.3%, minus inflation, which is 3.3%. That gives you a 6% real yield. Let's look at that versus other countries. And what you will see is we've highlighted where South Africa fits in, and it fits in nicely between Indonesia and Kenya. But if you look at that chart in terms of emerging markets, South Africa offers the most attractive, the highest real yield of CPI plus 6 for any of the established emerging markets. And it's really the frontier markets that don't have properly established financial systems, bond markets that are offering more yield, though significantly more risk. However, as a foreigner looking for reasonable liquidity, reasonable access to the market, South Africa continues to be the cheapest. So from that perspective, I think bonds are also quite attractive. This is all taking place in an environment where South Africa is actually in a Goldilocks environment. We've got a situation where the commodity cycle is pushing the rand stronger. We're seeing massive exports, in fact, record trade surplus last month has just been announced. And that is very positive, not only for the rand, but these commodity producers, the miners, are also paying tax. Our fiscal situation is looking less dire than it did 6 months ago. So things are looking better. Politically, we're starting to see some action from the government in terms of corruption. Again, things are slowly looking better. So you've got fundamentals that are improving, bond prices that are actually cheaper, and we think that this represents an opportunity. And the way we look at it is the same bond chart that I had previously showing you the bond yield, but against it now, we've got the red line, which is Anc's fair value of bonds. This fair value of bonds is pretty stable. We sort of triangulate a number of different measures into it. And what you can see right now is that the bond yields are trading above our fair value. And to us, that means that if you invest in these bonds, not only can you lock in an attractive sort of 9% yield, but there is a prospect of capital gains as well. Very, very appealing from our perspective, and hence the desire for bonds, and hence the overweight position we're going to talk about in a few minutes. In terms of fixed income, how do you express this as an investment? Because not all fixed income is the same. And the way we look at it is it's a function of how much risk you want to take. So in the zero risk environment, what you do is you invest in a money market fund, but a zero risk environment, you're probably going to earn about 4%. What the money market fund does is it invests in term deposits, 6-month deposits, 12-month deposits at banks. We then move to a core income fund where we say, well, why only banks? Why don't we lend a little bit of money to Growth Point, a little bit of money to Discovery, a little bit of money to Liberty, and incorporate that in the portfolio? Just by doing that, what we are able to do is actually raise the yield of your portfolio. But if you look at the expected return graph, it's actually a very, very stable graph as well. Start to see a bit of a wave pattern, but not meaningfully so. Very attractive for anyone who's sitting on cash holdings and needs a stable value of their investment. Moving across, a lot of investors say, but we need a bit more income. Even 4.8 isn't that exciting. And what we then start to do is blend in more of those government bonds that I was talking about, those bonds that are yielding 9%. You don't have to blend in too many, and you can push your portfolio yield up to 6.3%. We call that a flexible income fund. However, now we've got to accept that over time, this portfolio is going to average about 6.3%, but your returns are going to come and go. So you're going to see some months where the returns are a lot better than others. And, but, over a period of, 12 to 36 months, they're going to average each other out at 6.3%. And then finally, for investors, what we talk about is a bond fund where we say, let's strip out all of the defensive bonds and let's just invest in those government bonds that are quite attractive and hold that. Significantly, we're going to see months where there are significant positives, significant negatives. However, if you're able to hold this for a period of time, it actually averages itself out. It's what bonds do, and you expect to yield about 9.1%. Very quickly, ABSA surprised me. I actually had to pinch myself and say, was I reading this correctly when they closed their money market fund? In 2 decades in the markets, I haven't seen anything like it, an 80 billion rand money market fund closing, and for reasons I didn't totally follow. The long and the short of it is a number of alternatives have been proposed. ABSA is talking about they can convert you to a bank account. They're talking about they can convert you to their Prudential money market fund. Truthfully, neither of those is likely to really be the optimum solution for a number of people. And if you do happen to have money in the fund, please do think of the Anc Core Income Fund, which actually gives you a significant pickup in yield for not much more risk than you've been running historically. If that isn't appealing, please do reach out to financial advisors who can also give you advice on actually tailoring your fixed income investments. Pulling it all together, though, where do we come out in terms of asset allocation? I'm going to talk about bonds. Peter will talk about equities in a minute. But in terms of bonds, we're positive on bonds, and that's reflected in our asset allocation stance. We think that for a long-term investor, flexible income and core income is a little bit less exciting domestically, just because we think bonds are so attractive. So if you're a longer-term investor, we lean towards bonds. If you're a short-term investor, obviously the core income and the flexible income becomes far more pertinent to you. And then looking abroad, we are more cautious on government bonds, and abroad, we think that a lot of the correction has taken place. There may be a little bit more in store for us. However, we just think that in terms of earning returns abroad, equities are probably going to be a better option for most investors. So with that, just to sum up, where will the money be made? Domestically, we think that bonds are cheap. We see potential capital gains. We see them as attractive. And globally, bonds are a good store of value. It's a good place to park money if you don't want to be in the equity market right now. But globally, bonds aren't that exciting at this stage. With that, I just want to say thank you very much. And I'm going to hand over to Peter.
Okay, thank you very much, Nolan. And welcome, folks. There's close to 1,000 of you listening to this webinar. It's a pleasure to have you all here. And I'm going to run through the equity component of asset allocation together with Saleho, who's going to talk about a few shares. I think the bottom line is we're fairly bullish. Sorry, before I start, there have been a few people commenting that the slides are very small. We've checked with a lot of people. The majority seems to be fine. So perhaps if you could just check the setting on your own computer. But we'll keep an eye on that. Right, so let's talk through the equity world. I think following on from what Nolan had to say, where will the money be made? We've talked about fixed income. In the domestic space, we're actually fairly positive that the great conditions we've had for the last 6 months in local equity markets can be continued. At the moment, if you look at where something like platinum is now 10% of our market, resources is close to 30%. And if you combine that with NASPA, it's effectively about 50% of our market being driven by China. And we do think that the positivity in terms of economic growth and economic rebound in the globe is feeding through into emerging markets, and that's going to benefit China and by consequence South Africa. We also think the domestic South African equity Inc shares are still fairly cheap, and they've got some potential to re-rate. From a global equity perspective, the market has done phenomenally well. Investors in our segregated portfolios have received 15% per annum in dollars for the last 5 years, which is quite astounding if you compare it to averages preceding that. In Nick's Global Equity Fund, which he's going to talk about, that's 23% per annum for the last 5 years. So the markets are extremely buoyant. As we're going to show you, it's really flying out there. Economies in developed markets are bouncing back incredibly strongly. But shares are pretty expensive. So we have got some caution with regard to valuations. We'd be quite cautious in terms of putting new money into markets. But the baseline view is that we're in a bull market, and bull markets always start to feel expensive, and they can feel expensive for some time. But some incredible earnings growth coming through, which is justifying the stance we've had on equities for some time. So we'd remain invested in markets, but with a bit of caution. We still think there's some value in the reopening shares. We think there's great value in big tech. In fact, the Facebooks and Alphabets of the world are almost cheaper than the market if you strip out their cash. And then there's some banks and pharma companies that are relatively cheap with improving prospects. So the shares that have kind of been left behind for quite some time, we think there is some catch up to play. Importantly, the world is rebounding strongly. The brown lines here are the forecast GDP growth numbers from the International Monetary Fund. And importantly, sustained growth well after 2021. But we look at asset allocation and we try and do, kind of prospective returns. I think there's a few key things and premises on which we operate, which we'd encourage people to follow. First and foremost, we look to make you money. Second of all, our core investment philosophy is to invest in shares or companies that compound their growth, and we like to buy those at reasonable prices. Then within that, we want a core of solid compounding companies, over time 10 to 20% exposure to emerging markets, and at times even more than that. I think if you look 10 to 20 years out, there's going to be 4 to 6% growth from emerging markets from a GDP perspective, and developed markets are going to slow down to probably around the 1% level. And then we think it's essential to have 25 to 50% exposure to technology shares or companies whose futures have been accelerated by technology. We really are in an unprecedented time. Nolan showed you the asset allocation. The bottom line is, from a local perspective, after about 14% year to date in local equity markets, we think if the global bull market continues, there's another 12 to 15%. From a global perspective, a little more cautious. And that's because valuations are significantly higher than South Africa. And everything, a lot of stuff, while it's doing very well, is priced for perfection. So any disappointments can be punished, but we probably would see that as an opportunity to pick up more equity. Just a reminder of how the markets have done year to date. So I've just circled there, the JSE All Share. This is as of Friday, up 14%, and the S&P up 11%. We then spent a lot of time going through global and local company results. And I just pulled a few that really struck me over the course of the last few days. So, and consistent messages coming from CEOs about how strong the market is, about the fact that it's a coiled spring. We're talking about the economy and largely in the US. Unprecedented demand, a lot of pent-up demand. The CEO of Whirlpool saying that in all the years he's been doing the earnings call, this is probably the year that I'm most bullish about mid and long-term consumer demand trends. So people are not talking just about this year, they're talking about a multi-year boom from a consumer perspective. The Blackstone CIO talking about the economic dam starting to burst, and the head of Interactive Brokers referring to an absolutely spectacular quarter. So some very flowery words being used here for an economy that's, I think sitting in South Africa where things are pretty still tough, still pretty tough. And in a lot of emerging markets where we're kind of lagging from a vaccine point of view, it's going to take a lot of time to get back to these kind of numbers. Then this is the US. So as of Friday, we're about halfway through the first quarter US earnings season. And you can see here the blue line, the top line, is all securities. So the market earnings growth is sitting at 54% compared to the first quarter of last year. Now, obviously, importantly, things started to slow down at the end of the first quarter of last year. So you would expect some pretty dramatic growth. But if you go down to the line where it says surprise in the second block, the earnings surprise is 25%. In other words, for the companies that have announced year to date, for the first quarter, the expectation was for 25% earnings growth, and it's come through at 53%. And that's the key reason why the market has remained strong, and we're still on the positive side of the bullish line. Just a few that struck me, which are worth kicking out. Anything to do with luxury goods or people spending money in their kind of rebound, and the pent-up demand has absolutely flown. So some phenomenal numbers here from LVMH, that's Louis Vuitton, it's Veuve Clicquot, wines and spirits, fashion and leather goods. The numbers that I've circled there, the change for the last numbers against a year ago, we're up 36% for wines and spirits, 52% for luxury goods. Now, you might say that's just off a low base. So we went back another year. So the first quarter of 2021 compared to the first quarter of 2019, and still 17 and 37% growth. So all that pent-up demand, the stimulus that's flowed through into the economy is resulting in people spending in something of a frenzy. One of the reasons is the vaccine story is a very good one. Developed markets have been very good at getting the vaccine into people. And once the vaccine's in people, it's been very effective at slowing transmission and vastly reducing deaths. Israel is the one I like to look at closely because they're close to fully vaccinated from an adult perspective, and they're down to literally 10 to 20 cases a day. So the vaccine is working. In the US, they're pretty much going to be done by somewhere between July and August, depending on how you, on what you consider done. But developed markets, we are seeing the positive news come through, and stuff has been positive at the margin with some small negative blood clot issues in terms of numbers. But we're quite positive on this and all kicking through. However, we don't know what the future holds. There can be some negative surprises. There's been less than we expected, and that's why we are expressing some caution. This is the numbers that we do in terms of earnings growth around the world and forward PE multiples. And here what we want to show you is even if you bring into account the pretty strong earnings numbers, valuations are pretty expensive. So world earnings growth this year is expected to be about 48% and then 12% next year. The 48%, obviously a lot of it is recovery from a low base set last year in some industries. That takes you to a forward PE 1 and 2 years out of 19 and 17, which by historical terms is quite expensive. We think there's reasons for it to be trading at a premium. But there's also when markets are trading at a 30% premium on a forward basis, there is a room for a pullback at some stage. Interestingly, you'll see in the emerging market index, 12% growth this year and 21% the following year. And what that really is showing that emerging market growth is going to take another 6 to 12 months longer than developed markets. They're not fully vaccinated. The economies will be under pressure for a longer time period. So this is the MSCI World Forward PE multiple, and you can see that the red line is the average over time, which is about 16, and we're sitting now in around the 17 to 19 mark. So companies are pretty expensive, and one has to be very selective. We then get it's hell of interesting to see the differences in valuations, and what I'm endeavoring to show you here is the big tech companies where there's some fear about antitrust and the like. Facebook came out with results the other day, absolutely phenomenal numbers. One of the biggest companies in the world grew its turnover by 50% and its profits by 100%. Yet quite modestly valued. If we go down the line here, Facebook, this is in the quarter, ended March, $25 billion of revenue. They made $11 billion of profit in one quarter. If you multiply that by 4, you get to a PE multiple of about 22%. Importantly, and I think what people fail to realize with these big tech companies is massive research and development expenditure. So they spend $5 billion and they'll probably spend $25 billion this year on inventing the future, on AI and all the technology solutions that we haven't even thought about. So, we think a company like that is very attractively priced. By contrast, you get a company like Tesla, and Nick will talk about it in his presentation. Nick is very focused on high growth companies, and Tesla is no doubt that. So I won't go into too much detail. But this is just to show you how the market is prepared to place an aggressive forward valuation on a business that's really yet to deliver a bottom line. So by contrast to Facebook, about $10 billion of revenue, just making a little bit of income, and it's got a valuation up at about $700 billion. There was a point earlier on in the year when Facebook and Tesla had similar valuations. So that doesn't mean the company is a sell. In fact, Nick is extremely bullish on it. It's one of his top shares. But just to indicate across the market, there's different valuation opportunities depending on where you want to sit on the risk-return curve. And then I couldn't help myself but put Bitcoin in, which basically has no revenue, no income, and a market cap of 1.1 trillion. The S&P itself, earnings are strong. So what this endeavors to show, if you look at the dotted line, the long-term trend would in fact be exceeded once earnings bounce back in 21 and 22. So this is our expectation for global equities over 12 months is about 5%. And the chart on the left-hand side shows the range of potential outcomes, where we think there could be another 10, maybe even 20% in global markets if everything goes well. But there's also more downside. If there is a second or a third wave and there's a shock that we haven't anticipated, there's every prospect of a 15 to 20% drawdown in markets. And one has to go into it realizing that those are the risks. I'm now going to ask Saleho to talk through Netflix for us, which we think is a very interesting opportunity.
Thanks, Pete. Yes, so Netflix is really all about scale. That's kind of their competitive advantage. And you see that if you look at these two graphs that we have on the slide. So on the left, we have Netflix's content budget compared to the major media companies of the US. You can see that Netflix, in terms of pure entertainment budget, outspends its peers. But then what's really interesting is if you look on the table on the right, you have some of the major streaming services coming out of these media companies. And Netflix is comfortably in the lead in terms of subscriber numbers. So we think that on a per subscriber basis, what's very unique about Netflix is it's actually able to spend less on a per subscriber basis than its peers. And so it really comes down to these economies of scale. Even though it's outspending on an absolute basis, we think over time it'll be able to underspend competitors on a per subscriber basis in terms of its content budget. What's also attractive about Netflix is it has quite a long runway for growth. You can see that in the addressable market. Sorry, Pete, could you go back to the, you can see that in the addressable market. So Netflix today has roughly 200 million subscribers, just over that. And they've cited an addressable market of what they believe is between 800 million to 1 billion pay TV households outside of China. So that's the market that they're trying to address over the long term. Over the past few years, they've been adding between 20 to 30 million subscribers per year. Because of the pandemic last year, they added about 37 million subscribers. This year, there's a bit of, I suppose, indigestion in the sense that as lockdowns start to abate and people start to go out more, it's going to be a challenge for near-term growth. So we do think that there's a challenge in terms of near-term growth for Netflix, as people are going to be a bit tired in the second half of 2021 of staying indoors and not living life as we used to pre-pandemic. But we do think over the long term that they'll still have the ability to add 20 to 30 million plus subscribers per year and to really be the leader of the OTT, the online streaming market. So we think the runway for growth for Netflix continues to be very attractive, even though we do think in the short term, there's going to be a challenge as lockdowns start to ease globally. If we go to the next slide, one of the fundamental criticisms of Netflix, and it has been a concern that you can make, or previously you could make, is that this business didn't generate cash. It was burning cash. So especially as they looked to increase their original content spend, Netflix was increasingly burning cash. And that really peaked in 2019. Last year, they generated over $2 billion of free cash flow, which was quite a surprise to the market. That was helped by the fact that because of the pandemic, they weren't able to spend as much on content as they had anticipated. So their content spend was artificially low in 2020. But what's really interesting about Netflix now is that at the end of 2020, they guided that they believe they're going to be free cash flow break even in 2021. And then after this year, after 2021, they're guiding for the business to actually be free cash flow positive. So this has huge implications for the business and the share, in the sense that it means the balance sheet is no longer going to be under the pressure that it has potentially, it could have come under, and they should be generating cash and really either reinvesting that cash back into the business or doing things like dividends and buybacks. And they have talked about starting a buyback program. So we think that this is now a business that's in quite an interesting space. It's quite an interesting setup in the sense that they should be able to grow revenues over the long term at 20% plus if things go right and they can address that large addressable market. We think that free cash flows could grow faster than that as free cash flows start to ramp up from a break-even level in 2020 and 2021. And then what's really interesting is that if you assume a margin of about 25%, the shares at a multiple of between roughly 33 to 35 times, depending on the assumptions that you use. So we think that shareholders in Netflix should be able to earn a return that is quite close to that growth rate of 20% plus. And we think that's quite attractive given the competitive advantages that we touched on in the earlier slide. So this is a business that we find quite attractive.
Thanks, Salo. We'll invite you back to talk about one or two South African shares. So we do have in our investment approach a core philosophy of being in growth shares. But one of the things we like to do in our business is help people identify shorter term kind of trading opportunities or tactical opportunities, we call them. And something we've been showing our clients and guys have made a lot of money out of over the course of the last 12 or 18 months is what we call our tactical portfolio, where we bought companies which might not necessarily fit into our classic definition of a compounding business, but companies where we think their share prices have got big opportunity to rise. So we've had this recovery or tactical portfolio running since about April last year. It's delivered a return roughly double of the market, but we still think there's opportunities. And in fact, on this slide, I'm not going to go through in any detail because of time limitations, but we're happy to share it with you as clients. But the potential upside that we still see from these counters, if you look at the blue graphs, we think some big upside still in a lot of companies. And this portfolio, if it reached its potential, could deliver 36% over the course of the next 12 months. So we're always trying to find the next place in the market where there's money to be made. From a JSE perspective, I've talked largely about the globe. And South Africa fits quite squarely into that. The South African market is being led by global factors at the moment, a gradually improving global growth outlook. There's high yields, so currency strength, our trade balance. Because the economy is quite weak, ironically, you're having a lot of exports of things like platinum, but not much coming in. So a pretty strong currency. It encourages people to invest in the country and emerging market equity outperformance. So some of the themes that are playing out in the JSE, our equity fund has done about 15% year to date. So it's been a great place to be. And we still think if the world is in a good place and continues to deliver what we've seen so far, that the metals and materials can continue to do well if commodity prices hold. Our shares are pretty cheap. Cyclical recovery from the domestics, our banks, retail, property and insurance companies. So some exposure to the SA market is certainly warranted. The SA market, if it does really well, we think you could be up at 25%. And if you remember in global markets, we said if things didn't go well, you could go down 20. We think the risks on the SA market this time around are lower because our valuations are much lower and the currency is pretty strong. So if things did go a little awry globally and the markets came off, you would certainly see the rand weaken a bit from these levels. We think some of the commodity shares look pretty interesting. So again, we've asked Salo to talk through one or two. Hand it over to you, Salo.
Thanks, Pete. There's been a lot of attention on platinum, the PGM sector on the JSE over the past few years. And the graph on the right-hand side really illustrates why. Essentially, the basket price has driven these shares higher. You can see it's done phenomenally well over the past couple of years in rand terms. We think that Northern Platinum is a very unique and interesting story within the space. So if you look at the graph on the left, it shows Northern Platinum's production at the moment, which is roughly 500,000 ounces, and what they intend to get it to, which is about 1 million ounces over the medium term. But if we just take a step back and look at platinum from a bit of a bird's eye view, What's interesting about the sector is that you have the potential, it doesn't always come through, but you have the potential for cycles to be relatively long, because it takes 7 years at a minimum for new supply to come on from the time of announcement for a project to when you actually start producing from that asset. And so supply in the short term can be relatively inelastic and difficult to ramp up for these producers in response to higher prices. And then also, in addition to that, last year, because of the pandemic, it was quite difficult for these companies to produce. So their supply was also artificially restricted because of that. And then on the demand side, demand is probably the bigger question. So that's a lot more tied to global GDP, car sales, and jewelry. And it's been helped over the past few years by emissions regulations. But really, you have a question of how sustainable this demand is given the inelasticity of supply in the short term. Now, why we've singled out Northam in particular is the volume growth story that they have over the next couple of years. Northam's very unique in the sense that at the bottom of the cycle, or during the downturn in PGMs, when their peers, the rest of the industry was really pulling back on production, Northam, despite being under pressure in terms of their cash flows and balance sheet, made the decision to invest through the cycle. So they took a bit more of a longer term view with the conviction that prices would rebound. And they're now in a position where they've done so the capex has been made. They've spent the money on this capex, and it's really just about executing on this ramp up in production. So going from about 500,000 ounces of PGMs to 1 million over the next, we estimate, 4 to 5 years. And so this is really unique within the PGM space. If you look at some of their peers, such as Implats, for example, or Amplats, you don't have this kind of growth from a major PGM company. Because of this, Northam today is on roughly a 5 times run rate earnings multiple. And we think that could unwind quite quickly if they're able to execute on this volume growth story and if prices hold. If you go to the next slide, Pete. We have another commodity-focused company. So this is Anglo-American. Now, what's different about Anglo in comparison to Northam is that this is a more diversified portfolio of commodities. So whereas Northam is 100% PGMs, Anglo-American is much more diversified. They've got copper, iron ore, palladium, coal, diamonds, etc. So you're not betting on one commodity, although you are obviously betting on the commodity sector as a whole. But what's interesting about Anglo-American, and you see it in a few other companies in this sector, is that their portfolio of commodities is in quite a sweet spot in terms of the exposure. So copper, for example, is at a 10-year high. Iron ore, which we are a bit more cautious on, is at a 10-year high. Palladium's reached all-time highs. So several of the commodities within their portfolio are seeing quite a bit of pricing strength at the moment. What's interesting about Anglo-American as a company, if we drill down to it specifically, is that they're actually growing volumes in some of these commodities at quite a nice time. So similar to Northern Platinum, a few years ago, they really laid down the groundwork for some of these projects. For example, Quellaveco, which is quite a big copper project. It's going to grow their volumes by just under 20% starting from next year. And that's quite unique, particularly within the JSE. It's quite a unique exposure that you don't really get from many of the other diversified mining companies. The share at the moment is trading at about 5 times earnings, which we would expect. So I wouldn't say that's what attracts us to the share in particular, because we would expect the multiple to be low at a time when commodity prices are high. But what's interesting about Anglo-American, and you could say the sector as a whole, or some other companies in the sector, is that at the current run rate of cash that they're generating, it's likely that they're going to have net cash by the end of the year or close to it. And so we think they'll have the ability to get a bit more aggressive on cash returns to shareholders. So that's dividends and buybacks. And really it's it's going to get to a point where if you had let's say a 4 or 5 times multiple with a very aggressive cash return profile to shareholders, it can look quite attractive, even if we do acknowledge that these are cyclical companies and we wouldn't want to, for example, price iron ore at $190 in perpetuity. But it is quite attractive. And that's really the story.
Thanks, Alo. So that's it, guys. We've taken you on a little trip around the equity world. Just a reminder of where we think the money will be made. In domestic equities, we think emerging markets and South Africa will be a beneficiary of the global risk on investor mood. Chinese economic strength will benefit our market, with roughly 50% of the JSE driven now by China ultimately. And the domestic SA Inc. shares are fairly cheap and have the potential to re-rate. From a global equity perspective, we think it's increasingly about share selection as indexes hit all-time highs. You don't want to own all of these businesses at high valuations, but there's still some value in some reopening shares. There's some great value in big tech. We've showed you something like a Facebook is actually cheaper than the market, and it's still growing at phenomenal growth rates. And some value in the banks and pharma companies, which are relatively cheap with improving prospects. So that's the mix we've got. I'm now going to hand you over to Nick Dennis, who's been our star global equity manager over the course of the last few years, the best in South Africa in 2020, and a pretty unique approach, which I really think is worthwhile having some exposure to. So let's hand it over to Nick.
Thanks, Peter. All right, so I'm going to chat about some of the key themes that market participants are talking about at the moment, and then I'm going to talk about how I manage some of those things in the context of the fund that I run. Now, so I'll talk about the rotation trade, which both Pete and Nolan have spoken about, and some of those themes. I'll talk about, quite briefly, why I think the actually long-term secular backdrop is really unchanged. And then I'm going to talk about the Anc Global Equities Fund strategy, which is really focused on a small group of companies, which I call multi-baggers, and how they fit in within that, both the shorter and the longer term timeframes. Right, well, let's look at what is the consensus narrative at the moment, how are investors positioned. So as Nolan mentioned, one of the dominant themes or discussion points over the first quarter was rising expectations with regards to growth and inflation. Now, this chart is taken from the Bank of America Fund Manager Survey, and it shows investor expectations regarding inflation. So when this line is rising, it says inflation expectations of future inflation are rising, and when it's falling, expectations regarding inflation are falling. Now, what you can see is that inflation expectations are higher than they've been in the whole survey period, which is roughly 25 years. So certainly investors are expecting inflation. The other thing, and consequently, the factor that ties in with those rising growth and inflation expectations is that investors are positioned in cyclicality and in value shares in favor of value shares over and above growth shares. So they're positioned in materials, industrials, and financials. And so if you look at this chart shows the number of investors that think as a percentage that value will outperform growth. And again, it's the highest we've seen in the survey's history. Now, typically, when you see investors really all on one side of the boat, historically, that's a contrarian indicator suggesting that it may be time to look the other way. Now, I'm not suggesting that growth is suddenly going to rocket and value shares are going to crash. But what I would suggest is that these themes which dominate the narrative at the moment, they are no longer contrarian and they are very much consensus. And as such, you wouldn't expect these themes and these factors to generate some of the outsized performance that they have over the last couple of months. So I'll just put that out there as the first thought, at least sort of short to medium term. One of the major narratives, along with rising growth, inflation, value over growth, has been that rising interest rates are bad for growth stocks. Now, historically, this narrative is not supported. It's just not supported by data, and it's not supported by history. So what this chart shows, it plots the NASDAQ, which you can think of as representative of growth and technology shares. The NASDAQ is the dark blue line. And then I've plotted with the light blue line is the yield on the 10-year US Treasury. So what I've denoted different shaded areas to show what happens when interest rates fall and then when interest rates have risen. And what you'll note is, regardless of the regime, whether interest rates have fallen or risen, the NASDAQ has gone up consistently over the last 10 years. So I've just taken a screenshot of a snapshot in time, the last 10 years, but this holds through other periods in time. So the next pushback might be, well, interest rates are extraordinarily low at the moment, and so growth stocks are certain to do badly when interest rates are higher and rising. And so the counterpoint to that argument would be the late 90s tech bubble. So over that time frame, long-term interest rates, the US 10-year was roughly between 4 and 6%. And what's most interesting was the steepest part of the rally in the NASDAQ in the late 90s occurred between sort of mid-1998 and early 2000. And that coincided with a period where the US 10-year went from roughly 4.5% to just under 7%. So not only were interest rates relatively high, but they were also rising quite dramatically. And so, to my mind at least, I think the focus on interest rates is a bit of a red herring. And I think what is more important is liquidity and animal spirits and investor risk appetite. If we look on a more kind of secular basis, a long-term basis, I came across an interesting piece of research that shows that perhaps counterintuitively, interest rates actually bottom well after the end of a recession. So what this chart plots since 1954 till the present time is the US 10-year yield, and the shaded areas are recessionary periods. And then you can see what the beige squares denote is that if you look after every recessionary period, the interest rates have actually troughed multiple months or even multiple quarters after the end of the recession. So that would suggest, if past is precedent, that interest rates could actually fall to well below their trough that they experienced last year at some point over the next couple of quarters or years. I'm not saying that's guaranteed, but that would certainly be unsurprising if history is any guide. So I certainly don't believe that that lower interest rates are needed for growth shares to do well, but it's certainly on a relative basis that would be favorable for growth shares. And then why do I think that? I think disinflation is a much more likely outcome than inflation on an extended secular horizon. So I'm certainly not talking about the next couple of months, the next couple of quarters, or the next year even. But I don't think we have escaped the pre-COVID, post-financial crisis era that we were in before. So the first thing is debt. Debt levels globally are much higher than they were even around the sort of roughly the 10 years post-GFC. Government debt has risen dramatically. And as governments have to service that debt, that reduces the amounts of money that they can spend on other things. And as they fund that using by increasing taxes, that takes money away from the private sector that effectively acts as a dampener on demand. Secondly, demographics. You're seeing slowing population growth in most of the world. And you're seeing aging populations. So both of those factors are inherently disinflationary. And then finally, which I think is arguably the most important factor, is the acceleration of technology and technology adoption, new energy solutions, and I think we're in the early days, and I call it a Cambrian explosion of technology adoption, new ideas, new technology, and it's fundamentally disinflationary. So if you can replace your pay TV that costs you 1,000 Rand a month, 900 Rand a month, with Netflix that costs you 150 Rand a month, that's inherently disinflationary. If we're moving to a world of electric cars, that's going to reduce our dependence on, and it's more of a energy driven more by renewables like wind and solar. That's going to lessen our dependency on coal and oil, and that reinforces that chart that Nolan shared, where energy is just a smaller part of the basket. We're talking about a less inflationary world. Now, so my strategy is I am really ruthlessly focused or relentlessly focused on multi-baggers. Now, multi-baggers are companies and shares which can grow 5x, 10x over the next 5 to 10 years. So if you think about, Amazon over time, Netflix, Tencent, back in the day, you had Walmart, these kind of companies, and they can make a world of difference to your portfolio. What I'm trying to describe with this slide is in order to find multi-baggers, you need to use both sides of the brain. So fund managers, if you look, are typically quite left brain oriented. We're very spreadsheet driven. We're very logical. We're very numbers oriented. And that's all fine. But that's not enough if you want to find multi-baggers, which tend to be or are often fairly controversial, fairly unorthodox. The numbers often are quite murky and don't make sense. The leaders of these companies tend to be controversial. Think of Steve Jobs. I mean, we remember him very fondly now, but he was very controversial back in the time. Leaders like that. And so you need to lean into, in my view at least, you need to lean into the right side of the brain that's, creativity, imagination, things that are unorthodox, things that are that can be quite squishy and difficult to wrap your head around. And so you typically won't hear fund managers speak about that too much, but I think it's a really important, it's a very, very important input in finding multi-bags. So these are the top 10 holdings of the Anc Global Equity Fund at the end of at the end of April. What you'll notice if you eyeball holdings is that you probably won't recognize most of those names. This is a very different portfolio than you will see a lot of other fund managers hold, and that's really by design. We want to hold the names with the highest long-term potential, and because we like these, and they tend to be quite unorthodox at times. And so I'm going to talk very briefly about two of them. So the first name is called C. It's a company that's headquartered in Southeast Asia. Tencent owns roughly a third of the company. And C is a gaming and e-commerce company. And they were responsible for a hit game called Free Fire. It's a mobile game. If any of you have children that play Fortnite, this is like Fortnite, but Fortnite for emerging markets. And last year, this was the most downloaded mobile game in the world in 2020. At the end of the year, there were over 610 million people that played this game. And that's up from 350 million people at the end of 2019. And this gaming division, this game, is stupendously profitable. And operating profit grew 150% year on year in the fourth quarter of 2020. Now, what multi-baggers do and what C does is they don't just rest on their laurels. They don't just harvest the profits and pay it out as a dividend. What they're doing is they're taking every last dollar from their gaming division and they're reinvesting it in Shopee. Now, Shopee, on the slide, you can see the homepage of Shopee, which is their e-commerce site. And they operate right across Southeast Asia, which is a population of roughly 650 million people. Their biggest market is Indonesia, which has approximately 260, 270 million people. So it's a massive, massive country. And e-commerce penetration is, roughly mid to high single digits. So it's very, very early days. Now, Shopee was the most downloaded shopping app globally in 2020. So C is building the Amazon of Southeast Asia. And the numbers that Shopee is putting up are also simply incredible. So revenue grew almost 180% year on year in the fourth quarter of 2020. And now they're just starting to dip their toes into South America, starting to set up a presence in LATAM and in Brazil and Mexico. They're really the Free Fire, the game is really popular there. And they're using that as a way to build local awareness. Now, so C is the largest position in the fund, and partly it's got there because the share has done so well. So the stock has been roughly a 10-bagger for the fund since we bought it more or less this time 2 years ago. So that means the stock has gone up, call it 1,000% in the 2 years since we've held it. And at no point in that time has it looked like a very, very clean story. It's never looked like a Nestle or a Google. It's always, you've really had to peel back beneath the surface to see what was going on. And I make the comment on the slide, sell discipline revisited. As a fund manager, I often get asked, what's your sell discipline? When do you sell? And I think the real discipline comes in, if you think you found a multi-bagger, the discipline is to not sell. The discipline is to hold and to hold and to hold. And as long as the company's executing and they're growing and increasing their market share and going into new markets, the real discipline is not to sell. And frequently these shares look very expensive, and they will pull back, and they will suffer corrections, but it really, really pays to have a long-term horizon with these multi-bagger companies. Next, now, one name that you will recognize and which Pete mentioned is Tesla. Now, Tesla has got a very controversial CEO. It's a controversial stock, and that makes it interesting. Now, this is a picture of a Cybertruck. It is a visual embodiment of this company. It's very edgy. It's either cool or hideous, depending on your perspective. The Cybertruck, I think, is going to be launched likely sometime next year. And I think it is just going to be, even if, my wife thinks it's the most hideous car she's ever seen, but I think there are going to be millions of people, if not tens of millions, perhaps hundreds of millions of people that will want to buy this car. I think it is going to be an absolute monster seller. Now, Tesla sold or delivered around 500,000 cars last year. I think they've got a shot at selling 1 million cars this year. The consensus, the sell side currently thinks that they're going to sell 860,000 cars. We'll see where that ends up. That's not the most interesting part of the story. As we look further and further out, I think Tesla's lead just grows and grows and grows relative to the incumbent automakers. I think by 2025, they could be producing and delivering 5 million cars. Whereas consensus, the street, the sell side, thinks that they're going to do just over 2 million. I think they could actually call it 2 million next year and sort of beat the street's 2025 estimates by early 2023 in terms of the run rate of deliveries. So the pure EV side, I think, warrants, in my view, a much higher share price over time. And my view is that Tesla is going to be to the 2020s what Apple and the FANG stocks were to the 2010s. I think Tesla has got a shot a decent chance of becoming the world's largest company over the next 5 to 10 years. And I think potentially become the world's biggest company by a long, long way. And so I've listed some things on the right-hand side, which starts going into the realm of science fiction. But I think have a chance of just being, absolute game changers, not only for the company and their profits. And on that note, I think Tesla is going to be stupendously profitable over time. But these technologies are going to be game changers for the world and are going to change, frankly, how we live. So I think it's a very exciting company. I'm extremely bullish on it. Unfortunately, there's not time to delve in it any deeper. This chart is the unit price of the Anc Global Equity Fund since the start of last year. We had a fantastic run last year, and then more recently, as interest rates have gone up quite sharply, that has been a headwind to recent performance. As the US 10-year has stabilized over the roughly last 6 weeks to 2 months, performance has started to bounce back. I really don't focus on short-term performance, and I really encourage investors in the fund not to focus on short-term performance, but to really think in terms of 5-year plus horizons. But that said, I think the factors that have been a headwind to the fund are sort of largely priced in. I think that rotation has already taken place. So incrementally, I expect them to be less of a headwind than they have been thus far. But certainly, I remain very, very bullish on the companies in the portfolio. Covered C, covered Tesla. It is difficult for me to be anything other than just super, super bullish, because these companies are changing the world and they've got so much growth left ahead of them. Peter mentioned some of the performance statistics earlier. Frankly, we had a fantastic last 12 months. Hard to say what performance is going to be going ahead, but again, very, very bullish on the underlying fundamentals. One thing that I would like to highlight is using a multi-bagger as a case study in why long-term thinking is just so important, and what, in retrospect, these companies, it would seem easy to have held an Apple while it's done so well, or an Amazon, or a Netflix, or even a Tesla. You think, I could have. You look at the chart and you scarcely see the blips, and you think it's easy. But unfortunately, the reality is just not like that. So this is a chart of a company called Mercado Libre, which is held in the fund. And over the last decade, Mercado Libre has been a 10-bagger. A 20-bagger. That means it's gone up 2,000% over the last 10 years. And Mercado Libre is the Amazon of Latin America. It's headquartered in Argentina. And if you know anything about Latin America, you know that it's a region with high inflation or hyperinflation. It's had very mediocre economic growth. Currencies have been weak. It's just been a really, really tough place to do business. And yet, despite that, Mercado Libre has absolutely trumped the macro environment and has been a fantastic stock. But holding it has not been easy. So the gray shaded areas the red shaded areas are periods where the stock has traded 20% below its all-time high. And so it's sat at least 20% below its all-time high 1/3 of the time, which is it's easy to just say that, but when you hold the share and you're down well off its high, it can feel quite rough. And in the last 10 years, remember, this is after the global financial crisis, it's had a maximum correction of 46%, which is certainly not fun to go through. And you can see that on the bottom left of the slide in that red block. It looks today like a tiny little blip. And that, I think that also that illustrates the if you've got a long enough horizon, what can feel terrible at the moment, ultimately in the fullness of time, is just a tiny blip in the rearview mirror, as long as you've picked the right stock. So this is what we're trying to achieve. You've got to earn your returns, the multi-baggers. It's not a smooth ride, but certainly I believe the rewards are certainly worth it. So just to summarize and to conclude, I think, as I've highlighted, I think the rotation trade is very much consensus. It's no longer contrarian. And so I don't think you can expect the same rewards that you've had until now over the past couple of months. And I think what has been a headwind for growth shares and multi-bagger shares, I think becomes less of a headwind looking forward. I personally don't think the secular backdrop is unchanged. I think, if anything, some of these factors that are acting as a headwind to inflation are actually becoming more pronounced. And then finally, I hope I've outlined the case for multi-baggers and why the shorter-term pain, is worth accepting as a trade-off if you want to make those longer-term gains. So thank you for that time. And with that, I will hand back to Neil.
Thank you so much, Nick. If I could ask the panelists, please, to just come back online and put your videos on, your sound on. We attempt to be brief and bright and provide you with some useful insights. I hope that we've managed to deliver on both. I have been picking up the questions that have been posed. So I think we'll start and do it backwards. Nick, there are a couple for you. Firstly, regarding Tesla, will it ever be valued as an automaker and not a tech player? What effect would that have on its share price? That's the first question. And the next question was from Matthew Mattia. Rising interest rates increase the risk-free rate used in DCF calculations. Therefore, as rates increase, so will stock prices re-rate. Have lower rates not simply led to front-loading of the returns that your fund is invested in, since they are high growth and earnings are assumed long into the future? And will we see a slower unwinding of this return should rates go up?
Okay, so the first bit about Tesla, the people that hold Tesla are like me. We are believers, and essentially the people who think that Tesla should be valued like a traditional automaker are frankly not setting the price of the share. At the point at which Tesla trades on a similar PE to other automakers in, call it 15 or 20 years, is the point at which you don't want to own the share. I think Tesla's going to look, I think the analogy that I think of is Tesla's going to be more like Apple, where you build this massive installed base, and then beyond that, then it becomes more like a software company, and then you get into the realm of, robo-taxi and other things which are so transformational, not only for the company, but for society. And those will be super, super high margin, or will be pure margin business that you cannot value it like an automaker. You'll value it like that will be the most valuable income stream you can imagine. So I would say no. And so unless you get hard proof, the burden is on Tesla needs to really, really mess up now. They've got the lead, and now they really, really, really need to mess up for the sort of bear thesis to play out. So I think the probability of that happening is low. On to the second question. Low interest rates, could that have theoretically front-loaded some of the performance into last year? There's no way of knowing that for sure. I mean, that's probably possible. I take on board with the point that he's saying in theory, but I think that theory should have held in previous periods too. Clearly, it hasn't. What I'd also say is, my counter would be that I don't think the market ever truly priced in a risk-free rate of 1%. I think the equity risk premium part just expanded. So I certainly don't think that's the case. Look, longer term, if you hold these multi-baggers, your return, and Morgan Stanley's put out some great research where they looked at what drives top quartile performers over time and over a decade-long period, and that's how long I want to hold the best multi-baggers for. The proportion of that's attributable to valuation is negligible. It's next to nothing. The bulk of those returns are driven by the underlying sales growth of the company. So Amazon, Netflix, etc., Tencent, the returns have been driven vastly by the underlying growth of the business and not by interest rates. That would be my response to those.
Thank you, Nick. We'll give you a rest for a little while and flip over to Nolan, some questions for you. From Andrew Van Dam, with a huge excessive money supply, how else would money be devalued if not through inflation? That's the first question. And the next question is about our government bonds. How concerned are you about a default on government bonds or on corporate bonds? Very nice returns for clients with seemingly low risk, but would you be comfortable allocating a large portion to the portfolio at this point in time?
Thanks, Neil. So let's talk about the devaluation of money. And I actually spoke at the Where Will the Money Be Made about a year ago, where we said, look, there are a lot of factors that feed into what happens to that money. It's not necessarily always a case of you print money, it becomes inflation. Certainly, if you print enough of it, you will get there. I think Zimbabwe and maybe Germany in the 1930s proved it. However, as we stand right now, our historic experience with quantitative easing has been that within the realms of normal quantities, which we can debate, that what you end up with is the velocity of money slows down. In other words, you print more money, but the money gets lazier and lazier. So it just circulates around the system slower and slower. Reason for that is probably that a lot of the money gets spent on investment. So what we've seen is investment portfolio inflation, spectacular investment returns, but you haven't seen real economy inflation. And the question is, will you ever? And at this stage, if the experience of the last decade is anything to go by, probably not. As long as that money that's slowed down around the economy remains slow and it doesn't all sort of leave investments and move into refrigerators and television sets, then you're unlikely to see this surge of inflation, and it's been absorbed by investment inflation. Turning to South African bonds, are we concerned about defaults? As a fixed income manager, you're always concerned about defaults. We spend an inordinate amount of our time in credit committees chewing through who are we invested in, what are the actual risks. Looking at the corporate South Africa, obviously has been under pressure for a while. From the perspective of the portfolio, there's no one that I'm sitting here completely unraveled by, uncomfortable with. I think we've generally leaned into higher quality companies that are, broadly speaking, blue chip. So, African Bank, for instance, we avoided entirely. And that has served us well over the years. So we're comfortable with our portfolios. Extending that question, are we concerned about SA government bond default? Look, South African government bond quality has reduced. We have definitely seen a quality reduction, and that's evidenced by the credit rating downgrades. It's also evidenced by the increased cost of insuring against defaults in South Africa. That being said, our most likely scenario, or 2 points. One, is that the fundamentals in South Africa are actually getting better right now. So, our maximum debt level is probably come down. I wouldn't be surprised with, with commodity prices having done what they've done, if next time the Minister of Finance speaks, actually things look a little bit better again. So we're seeing a positive outcome there. That being said, can we use this to sort of turn around the ship and right the things fast enough? Time will tell. But the most likely scenario, if it goes wrong, is that it's a slow bleed out scenario whereby, gradually our cost of debt gets more and more, our debt burden gets more and more, and the minister keeps spinning plates for a long, long time. In that sort of environment, bonds are still going to be healthy investments for the next decade anyway. So at this stage, it's not something that we really are agonizing about, particularly in the team. I think it's if something goes wrong, it's probably too far out for us to really get excited about. Last question, I believe in diversification. So would I take all of a client's investments and stick it in the bond fund? Please don't do that. You need growth assets. You need to try and diversify across asset classes. I do think for a client that needs to achieve a sort of 7-ish% return, a bond fund actually should represent a significant proportion, maybe half of the investments. But don't disregard the other asset classes. There's a lot to be said for diversification.
Thanks, Nolan. And some stock-specific questions. Maybe, Pete, if you could pick them up. Disney Plus is only currently available in select markets and not yet global. Will that not slow the subscriber growth of Netflix once they open up to the world? And then another one on Netflix, which is kind of related. How real is the risk of access to content with guys like Disney moving into the space? So those are the next Netflix questions. And there's one on Amazon. What is the possibility of an Amazon stock split? If it occurs, will the upside be higher than present?
Yeah, so Silo, you can add to this if you want. But from a Netflix perspective, I think the massive appetite and take-up of Disney Plus, which is now sitting at, well, Disney as a whole sitting at around 100 million and projecting 350 million users by 2024, is an indication of the appetite and the potential market out there. Now, I think, as Nick was saying, on pay TV in South Africa, people were in many cases, are prepared to pay 1,000 Rand for a DSTV package. These products from these suppliers are coming in at kind of 150, 200 Rand each. So we think certainly in higher LSMs or in other parts of the world, you'll end up seeing people have a few of these packages. The space is becoming more competitive. I think what Sileo showed you is Netflix is outspending the others, and you get that beautiful benefit of critical mass. Where your R1 million you spent on production now it goes across 200 million subscribers, and next year it goes across 220 million subscribers, etc. So I think there's space for everybody, or space for 4 or 5 big players. That's what we build into our models. From an Amazon perspective, a stock split is a distinct possibility. We have seen theoretically, as most of the viewers will understand, a stock split doesn't increase the value of a company. It's one pizza which now has more slices. But when the market is in a bullish mood, you have often seen that impact the price positively. And you've seen it with a few companies over the course of the last little while. Yeah, that's
just to add on Netflix. I think in a way you could say that Disney is almost the exception that proves the rule, in the sense that Disney is very unique in that it has the scale and the brands and the content to provide a viable competitive offering, whereas some of the smaller offerings that you saw in that table with the subscriber numbers, they just don't have the scale to really compete with Netflix or Disney. And so they end up having to sell a lot of their best, or license a lot of their best content to Netflix, actually.
Thanks, guys. We've got loads and loads of questions. I'm afraid we're running out of time. We're not going to have a chance to answer all of them, so I'll deal with 1 or 2 more. Maybe just to say, because the questions have come through, we will be sending out a copy of the slides, or at least links to a copy of the presentation and the slides post the event. Probably only happen tomorrow because we've got to sort of tie it up and edit it before we send it out. Also, your CPD points, you don't need to claim for them. We will mail those out. That process takes a bit longer. For those of you familiar, we need to apply for the points from the FBI. That takes a couple of weeks. And once that's all done, we'll mail all your certificates to you. So you don't have to necessarily do anything. I will deal with one or two more questions. First from Janice Roberts. There have been media reports that President Biden plans to increase capital gains tax on wealthy Americans to about 40% from 20%, at least 39.6%. If this occurs, how will this play out for US and world markets? Don't know, Nolan, can I throw that one your way? Or Pete?
You can indeed. Fortunately, I was actually reading research on this yesterday, which says it was a rather sad Sunday. So specifically, it's not media reports. It's actually a reasonably concrete plan. But the key factor to note is that President Biden's intention is to tax individuals. He's not raising the capital gains tax on corporates. So it's individuals and specifically your wealthy American families. Estimates are they've got about $1 to $1.5 trillion of capital gains that haven't been realized. How does it play out? Well, theoretically, individual tax has a very limited impact on corporate valuations, and that's what you'd expect to see. So there's very little theoretical impact. Practically, if you look at previous times that the US has raised capital gains tax, what you've seen is in the quarter where they raise capital gains tax, equity prices come under a little bit of pressure. Maybe people take the view of I'd rather pay 20% now than 39.6% in 3 years' time. Sort of makes sense. And they therefore, crystallize some of the capital gains. It tends to be a very, very short-lived phenomena, and then the markets tend to recover. So it's going to have a very limited impact from that perspective. From the perspective of broadening the US tax base, from the perspective of using that to sort of repay some of the debt, I think that's quite positive for financial markets in the longer run.
Thanks, Nolan. Right, let's take one more question. This one comes from Michael John Dippenaar. On your asset allocation breakdown, both international and local alternatives were highlighted as high growth and anchor asset allocation areas. Would you care to elaborate on this strategy on a macro level and options available from Anchor? Peter, if I could ask you to deal with that one.
Yeah, sure. So it's a space that we've always backed and had a play in. With valuations pretty high, and we think a lot of companies price for perfection, we think alternatives play a valuable role in an asset allocation mix, and there's space for kind of 5 to 20% in the alternative space for a high net worth individual specifically. So our kind of flagship fund is the Anc Accelerator Fund, which has delivered kind of 15% plus compound returns year in, year out for quite a few years. It was the top long short fund in SA in 2019 and right up there in 2020 with returns of 30% and 19%. So it's just a different tool set where a fund manager has the ability to make money out of markets going up and down and not necessarily just out of long only shares. So we think it plays an important part of a portfolio. We've got a long-standing, well-established, great-performing team in that space. So for anybody who wants to talk more about alternatives, it's certainly part of our armory and part of our belief in how you achieve returns over time.
Brilliant. Thank you very much, everybody. With that, we've reached the end of our time, and we're always very mindful and respectful of your time. We really do appreciate you taking the time out today to spend it with us. We hope that we've been interesting and informative. As I said, we will be sending out a mail afterwards with all the links and CPD points to follow. Really appreciate it. Thank you and have a brilliant day.